your claim to fame with me is you worked early at YouTube on product, correct?
Let's detangle what claim to fame means. It means when I first had a position important enough for you to spend time with me, it was when I was at YouTube.
That's what I mean. What else would you judge this on? I push record. Let's see what happens. Here it is. Hunter Walk, dressed today as Grizzly Adams, one of the toughest looking venture capitalists in America, but a softie, a rather softie. So welcome to Investing for Profit and Joy, Hunter.
Thank you so much. You know, the beard started off pre-2016 election. It was like a rally beard. You know, sometimes you see like the ball players, like I won't shave until we win the World Series. Then my team lost the World Series, so it became a resistance beard after the election. And now it's a lifestyle. Now I have to buy product. I have beard oil. It's very complicated.
Laz did the same thing. I feel, is it uncomfortable?
No, it doesn't itch. My wife would like it shorter. My daughter argues that she'd like it longer. So it's like the first example, I think, of them bumping heads. And I'm just the monkey in the middle.
When I think of Hunter Walk, I think first, what the fuck with the beard? But the second thing I think is YouTube.
Yeah, I can't do anything about your videos. I'm sorry. If you keep emailing me about why they get taken down.
Or subscribers. So when did you start at YouTube? Hunter Walk is now at HomeBrew, where they invest in home brewing, I think.
We do get some hospitality pitches every once in a while. I think I've gotten us off most of the I'm opening a bar and need some money.
I tell every startup in San Diego that they have a brewery. I said, call HomeBrew. I mean, come on.
Yeah. Although frankly, the diligence process for a microbrew is probably much more fun than most of the things we invest in.
So HomeBrew now, Fund 3, investing out of Turn 3, but YouTube.
I was fortunate enough to be at Google already working on AdSense. And then the YouTube I had been working on some of the monetization of video formats. And then the YouTube acquisition happened. And I tried to pitch them on just taking ownership of the projects I was working on. I didn't think I was going to go over there. Yeah. But the reverse sort of happened. Chad and Steve basically said, we've got a lot of work to do. Maybe you should come over here. And that was, so I said, sure. And that was sort of, let's call it like January 1st, 2007. The acquisition closed November, December of the year prior, 2006. And I had joined Google in 2003. So it was great. I loved, and I spent a good amount of time, 5-6 years at YouTube. And it helped. I had a lot of the Mountain View Google relationships. So it helped some of those integration type of activities. But I also went native very quickly. And so I really felt like a YouTuber, who just happened to join after the acquisition. And I think that was what that company needed. It didn't need somebody to, sort of try to go make Mountain View happy. It needed somebody who could work with the founders and work with a great team to figure out what YouTube could be.
I'm going to jump around because that's what I do. Now that you've worked inside a rocket ship or 2 or 3, however many, because other companies within Google, and then you've invested in a rocket ship like Chime. Is it more fun to be inside a rocket ship or just wave at it and just make money off of it?
Yeah, I don't think I could be doing, if we think of venture as helping versus doing, I don't think I could be helping if I didn't have first a career doing. And I don't mean that from I wouldn't be qualified to be an investor or nobody would take my money or things like that. I mean, maybe those things are true too, but I just mean more from a personal disposition standpoint. I really enjoyed the times being inside the org chart and the responsibility for, figuring out that rocket ship. Being in year 0 to 5 at some places, and beyond 5 at others, it did help inform that I enjoy those first years the most. And that's frankly the reason when we started HomeBrew that we decided to focus on seed because we wanted to be present, albeit from outside the org chart, during those that seed to Series B period. Look, when I'm 80, I doubt I'll be thinking back to the IRR, spreadsheets from the fund. I think I'll be imagining, and remembering the people I worked with. That's still really what matters most. I mean, don't get me wrong. I hope when I'm 80, I'm sitting in a very nice house that the IRR paid for. But it's, it's not the investing part is sort of the means to the end. And the end game is, how do I get to spend the second half of my career just working with amazing teams during those early years?
And are you over 40?
I am. I'm 47.
You look good.
Somebody told me the other day, he said, I guessed 42. And I was like, you don't usually get sort of that type of, difference. People sometimes say, I can't believe you're not in your 30s. And I'm very flattered by that. But you don't look older than 42 was sort of a weird comment.
How old do you think I am?
I know you're a few years older than me.
I would take a few years older. That's 50. I'm 55.
Yeah,
so,
that's a few.
Yeah.
We're close enough in the same generation that I understand your movie references.
I have ear hairs older than you are.
That has more to do with grooming, I think, than age.
Either way, I worked in a Manscaped ad there for one of our companies.
Live read. Time to do a live read.
This episode is presented by Masterworks. My wife Ellen and I are longtime contemporary art fans, having collected contemporary art for 20 years now. So I was thrilled to have Scott Lynn, the founder of Masterworks, on the podcast to explain the fascinating art world and how exactly this industry operates. The art market allows us to think about diversification and fractional ownership in such a unique way. This is an amazing industry that remains uncorrelated to other investing classes. Every investor will enjoy listening to this episode, I promise. Head over to howardlindzon.com/masterworks to give it a listen. The link is also in the description of the video.
How did Chime, I'm jumping around, Chime is a neobank. I don't think of you as a fintech investor, but you've done well. We've had one home
Chime, Plaid, Gusto, True Accord, Phoenix.
See? Well, that's how
others. So maybe you should think of me as a fintech
Thanks
investor.
for sharing all those, first of all, knowing that I'm a fintech investor. But we did one deal together. We were small investors, Building Connected. That was a great founder.
We made some money there.
Woo! That was a great deal for not having to do any work for me. Did you have to do a lot of work on that deal?
I did work, but it's okay. I enjoy the work.
And how do you come to terms with the fact that sometimes you don't have to do work? Like at Robinhood, those first 2 years, I didn't work inside the company at all, but from helping them get their first, with all the stock to retire, helping 20, 30, 40,000 people email me and ask for ask for links to
referrals. I like it. See, free stock, right?
It was the free stock, but it was mostly like, how do I get me in the beta, or versus not having to do anything. Like Building Connected, Tom said, we're in, and get 18 times our money or whatever the number worked out.
Look, the way I think about it, we plan to allocate and do allocate, more than 50% of our time to supporting the companies we back. Mm-hmm. And so we invest with the notion that we're going to be doing work. Mm-hmm. Sometimes that work is, things are going great and you're just trying to help them recruit, help them, figure out, should they raise another round preemptively, that type of stuff. And sometimes things are harder and you're working through different questions, forks in the road. I think what's important, for our model, we sign up to do the work, but we also realize that all we can do is help the company become the best version of what it's going to be. So our job is not to parachute in and try to fix things that the team needs to figure out themselves. And also sometimes what it means to be doing the work ebbs and flows and is not you can't do the work because you're seeking control or because you want to be associated with something awesome. You do the work because you've earned the trust and the context to be proactively useful, not just reactively useful. I think anybody can sit back and wait for the email that says, hey, does anybody know the CEO of XYZ company and introduce me? That's fantastic. There's lots of people on a cap table who that's their primary way of interacting. But we try to spend a little bit more time, get to know the founders a little bit more. And I'm okay if, in the half of the companies that don't work out, whatever, I quote unquote threw good time after bad. Like that's what I think we sign up for. And I guess what's the old, I don't know who to attribute it to, but the old cliche, like you make your money on the deals that work and your reputation on the deals that don't.
Yeah. So fintech, I forgot how much overlap we have, but there's fintech so big. So you did neobank, You did infrastructure, Plaid. Who was is it you or Satya that's into fintech? And is it just two of you, or do you have associates now?
Just two of us from a partnership standpoint.
Right.
We have a team of 5. The other 3 people are our office manager, a head of talent who's been with us since very early on because we wanted to make sure that our companies build great cultures, great hiring and retention vehicles, and a principal who joined us, Kate Stern, who joined us February 2019 after 5 years at Uber and 5 years at Goldman. So
does a principal mean they can invest? A principal means they can write check?
At the end of the day, we all make decisions together, but it's Satya and I who sort of control the checkbook.
And so who was the fintech interest, or is it just fintech deals came your way and they're good deals, good founders? Are you guys generalists?
We're generalists with evergreen interest, at least in a few spaces. I'd say if you went back and read sort of, our founding memos, like our original blog posts, we talked about a few things, benefiting from what we called, the bottom-up economy, the idea that data and information would be made more available, less siloed, new products would be created, that millennials and successive generations were going to be asking for new solutions, especially in sort of, let's call them low NPS industries. And we identified fintech, SaaS, future of work, marketplaces as some of the areas that we thought we'd be interested in. That just happened to be the intersection of good curiosity and good timing, 2013, 2014, 2015. Indeed, a lot of entrepreneurs started turning their attention to this space. We're both interested in it and spend our time on it. I'd say of the two of us, Satya's the person who, if I was going to give credit to in terms of doing the work, has been so instrumental in not just the initial investments, the Chimes, the Plaid, so on and so forth, that we sort of came at together, but in sort of seeing and perceiving different parts of the value stack that we should be looking at, as opposed to sort of just following the herds, right? So we moved pretty quickly. I mean, I guess Plaid's an infrastructure company, but we moved pretty quickly to infrastructure in Fund 2 and Fund 3. And that's where you see the Phoenixes, the Hummingbirds, the Orums, and a few others, companies that are really sort of either creating payment rails or moving money around in different ways, dealing with regulatory, basically saying if there's going to be 1,000 Chimes, 1,000 Robinhoods, 1,000 whatevers. Hopefully none as successful as ours, at least until we see liquidity. Yeah. But let's start investing in the rails for those, rather than just trying to pick, who's going to be the runner-up neobank, or who's going to be, it's Robinhood, but it's with a better social feed, or things like that. Like, some of those may turn out to be great businesses, but we tend to, I think if you're doing seed and you're doing concentrated seed, you have to mix. You have to see and win some consensus deals, the things that, pattern match against who's building them, the industry they're building, and so on and so forth. But I think it's also really important that you find and pick non-consensus deals too. Things that at the time didn't seem mainstream, didn't have the billion-dollar funds all salivating. Because if you can time that right, if a deal can be non-consensus at seed, and then consensus at A, B, and beyond, that's where you get sort of the ownership, times the rocket ship. Chime, and Chris Britt, CEO of Chime, will talk about this, quite openly. He knew the model was going to work, or felt really good about it, but it wasn't showing its numbers really until almost, post B. And so the Series A and Series B rounds,
neobanks were,
took investors with real conviction, and now they're sitting on, multiple fund returns. But it's just, I think it goes to prove that not every screaming winner was well understood by every investor at every stage.
Greatest point. And in the public market, same thing happens. Apple's kind of was non-consensus from iPod through until recently, right? And even recently, when they went to service model, it wasn't consensus, meaning the best companies, even when they go to public, Peloton, Netflix, they haven't been they've always had people like, if this isn't going to work, you know what I mean? Like, hardware, it won't work. Right. Peloton, Netflix, competition.
Yeah, I mean, you're more of a public markets guy than I am. But
I'm both.
I assume that to some extent, when there's 100% belief, you sort of find a peak. It's the friction between belief and non-belief that creates upside, right?
Yeah, and I said that about Bitcoin. I said, like, if Fred and Wilson, and if it's good enough for Fred Wilson and Chris Dixon, it's good enough for me. When Warren Buffett starts liking it, maybe I should move back to something Fred and Chris.
Yeah.
Start all over again. Like, so that area in the middle is where the money's made. I don't have to be Fred or you or Chris Dixon. I have to be near you, and I have to understand what you're doing. This is why I talk to people like you all the time, and you're nice enough to share this stuff. And then I go look at what's happening in the public markets now with SPACs, and that was caused by what happened at the D&E rounds from Massa. These are all things that are happening, and there's no consensus around SPACs. To now, everybody, 44 billion raised in SPACs as of this year, this year, and people are like, oh my God, I got to, like, if I'm going to make my numbers, I got to understand what SPACs are. So we're a long way from consensus there. So there's, when you talk about consensus, it's like it's all through the food chain. And like Robinhood, there was no consensus maybe until this round.
Yeah, I remember.
It's silly, like 11 billion, but there's consensus finally where all the VCs are like, this is something. Yeah. And because there's only one, which is rare, neobanks, you've had to deal with hundreds of worries. All, is it going to come from Europe, or the bank's going to come for this? Is there margins in that business? You know what I mean? Like, I can only imagine the Chime, because I'm friends with Russ Fraden, who I think is
and Russ might own more of Chime than we do.
Yeah, I mean, he's an amazing investor. So consensus is so true. Yeah. And I think that's what I love about seed investing is, there's more eyeballs, feet.
I think there's an intersection though. I'd push even a little bit further. I think there's both. I think to be an investor, you also need to understand, fit what lanes are right for you. It's very interesting. Like, I was always when I was at YouTube and leading product there, like, that was my life. I had blinders on. I was obviously curious about everything else going on in the world, but, my job was just to, help build that product. Being a somewhat generalist, we have to, and being limited by time and capital, we also have to make decisions about, that may or may not be an interesting area. Is it worth spending time on at all? Like, so for example, in hindsight, this seemed like the right call, but at the time we didn't know. We said we were going to sit out the VR boom of, sort of 2014, 2015, 2016, 2017 for two reasons. One, my previous experience working at this virtual world product, Second Life, in its early days, made me believe that the sell-through on the hardware, that VR was hardware dependent, and the sell-through on the hardware wasn't going to be as aggressive as people were hoping.
And this is what, 20 years ago?
Second Life? Yeah, 2000 to 2003. Mm-hmm. And the second was, there was too much consensus in the market. So all of a sudden, if we were mildly interested, and you have everybody else, a lot of people with very deep pockets being very interested, it just didn't seem like the right thing to do. Now, you look back and you're like, oh, you were prescient, you made the right call. But with the way we were thinking about it at the time is, we might very well be wrong. But so long, our first fund was a $35 million fund. So long as we're right about where we are investing, it doesn't really matter if we missed, the Google of VR, if we hit the Google of fintech.
That's the key that I try and think that has made us successful is we just stop. When I was a public market investor and competing against the S&P, that created so much stress. Like, I'm sure when you had a product or working on product at Google, worrying about what Vimeo and 1,000 other Rever and whoever you crackle, whoever you were worried about, it's hard because, like, what are they doing? What's their numbers? Not just what our product is, and how do you focus on what you're supposed to do. As an investor, you can only do what you can do. I don't want to read everything. Like, I would like to expand my knowledge, but the fintech has created I just keep getting deeper into, I just started discovering infrastructure, with Alpaca. So with Chime, so you're just seed, or will you do an A?
Yes. Every once in a while, we'll enter at A in a minority position. So, we'll put $2 to $3 million into somebody's $10 to $12 million round.
Right.
We don't do that.
Same with us. Twice. We've only done it twice.
Often. Yeah. Even though the ones we've done in aggregate have worked out well, it doesn't feel right in some ways because you're catching something. It feels like more of a financial investment than an investment in the people, right? You're betting on the curve. Yeah. And I sometimes, like, that's the trade-off. I don't get as much of a chance to, make up for my mistakes, right? We might still have access and knowledge, but we passed at seed or didn't see it at seed, and then we try to make up for it. But it feels a little bit different. And And starting out with the lower ownership percentage, but still wanting to imagine a pathway to returning the fund, just means that we have to essentially use, 2 spots, right? Let's take the equivalent of 2 company seed checks and be willing to put that into an A. And it still needs to be a quote unquote non-consensus A, because otherwise, there's too many pigs around the trough anyway.
Mm-hmm.
But I don't want to preclude it. But I'd say, we are a seed fund, and we're looking essentially to get to 10 to 15% ownership during somebody's seed round, whether that's, takes 1, 2, or 3 raises type of thing.
Mm-hmm. So I want to go through 3 things.
Yep.
And what they look like. You've seen at least 2 rocket ships. So fund 1 was what size?
35.
Fund 2?
64, 65.
Fund 3?
90. So what we've done is we've essentially
nice progression. We're with 621, 43, 75.
And it's 20 companies, 2.5 years, 27 companies, 3.5 years,
27.
30 companies, 4.5 years. So essentially what we've done is we've held constant on the number of investments per year, 8 to 10. And the funds have grown as we have lengthened the fund cycle, plus the inflation rate it takes to get, 10 to 15%, right? You sometimes see those like consumer durables, like inflation graphs where like milk and eggs, essentially only prices only inflate like 1% a year. And then you look at like education and healthcare, and the lines are off the chart. Yeah. Seed rounds look more like education and healthcare.
Got it.
So we've had to grow our average check size, but we've very much stayed in our lane in terms of wanting to say, look, it only takes 1 or 2 really great outcomes to be a very good fund, and let's make sure we're always benchmarking against that.
So you benchmark more against. It's interesting because we're the same way, because you don't know until you know. You got to make you do one and you go, we love this, and then you do one and go, fuck, we won't even have to work on that. It should just return the fund.
Yeah,
but you don't know until you know.
We were fortunate enough to be institutional LP based from Fund 1, so we've always had a stable set of partners. As we've proven some things, the demand for access has far outstripped the fund size. But we've deliberately remained disciplined, right? Which I'm not sure, look, some of that is smart, right? Our own portfolio management strategy. Some of that is privilege. Sach and I both, we started HomeBrew in our late 30s. We had put away some money from our earlier things. So I didn't have my AUM, didn't have to drive a salary. I can play the long-term game. And then some of it is like, I don't know, in my 20s or early 30s, I probably had more ego, or at least I would have thought about the size of the funds and are we growing and am I going to be on a magazine cover as maybe more of something I cared about now. And now it's like, I don't want to be on a magazine cover. I don't care. I rather, I mean, what do we have? Like $200 million under management cumulatively or something. I rather turn that into, $1 billion, $1.5 billion and quietly take my share of it than, fight over the Midas list.
Yeah, we're the same way, Tom, Gary, and I. So the 3 investments, let's start with Chime. Seed investment.
Yep.
All people, or was there a thesis around that?
Well, it fit interestingly what we thought from a fintech perspective, in the sense that changing regulatory environment was going to allow for new types of entrants, and low NPS, low net promoter score industry, where successive generations would be willing to trial new products, right? If you weren't going to necessarily use the bank your dad used. But then it all came down to people. So Chris, the CEO, first-time entrepreneur, but career that was perfect for leading up to this point. He had been on helped develop the prepaid card business at Visa. He had been at Green Dot. His partner, his technical co-founder, Ryan King, incredibly smart guy, had been at Plaxo, so understood networks, understood scale. And I think sometimes, it's interesting. You sometimes want entrepreneurs to sometimes being a little bit naive about how tough a business is can be good, right? Because nobody would start a business if they, understood how complex it is sometimes. But I think in fintech, especially when it touches regulated areas, understanding where the risk is, understanding what you can control versus what's going to be relationship-based versus what's going to be regulatory, like Chris had this down, back of his hand, right?
Yeah.
And so we looked and we said, this is probably very likely the type of team that solves this problem. And I'll tell you one other thing, Howard. They were focused from day one on the average person, right? Not, hey, Google engineers need a better credit card.
Right, that's where like Wealthfront went, but yeah.
Or the quote unquote unbanked, right? So they weren't going after, it's a noble, they weren't going after payday loans. They were going after people, shift-based and full-time workers who were unhappy with a financial system that made money off of fees and other sort of predatory practices. And when we met them, their test markets were going to be Kansas City, Sacramento, Phoenix. We loved that they were a Bay Area startup that was not focused on their backyard from a customer standpoint, because I'd seen so many people, and we'd seen this, it was one of the challenges, maybe they were just too early, but I also think some of the challenges with Simple and others were that they went after, a very, very competitive class.
Yeah. So interesting. So the seed, what was the price of the seed? Do you remember?
I don't remember. Certainly sub 10, right? Both in terms of time and so Tim Connors from Pivot North had put in.
I just talked to him. He's like, he's in like Yellowstone. He's in Wyoming. Smart guy.
So he had put in the first check, and then Forerunner and us co-led the seed, because at the time there was more of like a merchant promotion bent. They were thinking that what they would do, the incentive would be, oh, hey, get this card and you can get $1 off your Pete's, you can get this. And of course, Kirsten, knows merchant, retail, that sort of consumer behavior cold.
Wow, so Forerunner did this one, not just e-commerce, she did this one.
Yeah, and it turned out that that was a terrible idea, that actually you should just build the bank, not build like the honeypot that's going to then say, how about a bank? And so that was part of the challenges. They had to sort of think through that model a little bit. But obviously it's worked out well for all of us early investors. And then Crosslink came in and did the A, and from there,
And how do you decide, just for other young people watching, because we've sold some Robinhood along the way. Have you sold any along the way?
We have. We have sold small portions twice, I guess.
Okay.
So their ramp looked like this, and then all of a sudden like that from a valuation standpoint. Over the course of a very short period of time, talking in generalities, 500 million, 1.5 billion,
6 billion,
5.5, 6 billion, 14.5 billion.
Yeah.
So we sold two small portions. I think
portions.
between the five, like once they started hit the 5.5, the way we looked at it was, at any, and I think a lot of this is art and science, but we think about it three ways. First, do we think the company, how far over, every investor theoretically is paying a valuation into the future, right? How far over its skis do we think this business is? Mm-hmm. We've never thought Chime was too far out over their skis. So like that sort of always de-risked. Second was, are the investors and the last round's terms, are we all still aligned? Is the cap table aligned? These terms, the investors are great investors. There's never been any structure in these deals. So we've all felt aligned. And then third is, from a portfolio management standpoint, like, should we be willing to take a little bit off the table in order to start hitting our return thresholds?
The DPIs,
not because our investors have asked or anything, but because we feel like that's the responsible thing to do. And the simple shorthand we've asked ourselves is, if we sell a portion and the remaining stake doubles from where we sold, will we be mad that we sold, or will we still be happy?
Great.
And the answer every time, and this sort of influenced when we decided to take money, how much would we take off, was always, it started to get to the point where we could take off a small, part of our ownership and get a half to full return off the fund off of that. Yeah. So it was like, oh yeah, I'll take 35 million off the table and still have multiples of that on paper. Like that just seemed prudent to do. Now,
that's a really good explainer. Yeah.
With this latest financing and so on and so forth, we'll have to think about it. I've always, probably, start to take maybe, if it's available to us, maybe.
Because it's like a public company at this point.
Right. So it becomes, at this point, I think,
you did your job.
I think everything is lining up that if they choose to be a public company at some time, I think it'll be a well-received public company. So the question is always like, well, how long is that going to take? what's going to be, how much more value gets created until then, and then with a lockup and so on and so forth, like how much premium are you willing to trade? How much are you willing to pay? Or for liquidity now versus illiquidity later. And frankly, I'm probably a little bit more conservative in the sense of, there'll be people who say, hold your winners forever. In fact, don't, take your allocation in stock and don't sell, And then I sort of think, if you've done a good job picking, you can't screw it up too badly. Like maybe you can sell too early and turn an 11x fund into a 9x fund,
right.
But you're not.
Your investors aren't going to judge you. That's what I tell people. It's like investors aren't going to judge you if you're 5 or 10. Once you're above 5x.
So I sort of feel like we're now in the point where, knock on wood, everything continues. We're in top percentile performance for our first fund. As soon as the Plaid acquisition closes and that type of stuff too. And so I want to I want to have some portion that I set aside as risk, and I want to have some portion that I incrementally manage and take off the table. Because I can't control macro, I can't control, I don't want to have to think about all that stuff. I just want to know that, I'll end up somewhere certainly north of, and hopefully well north of like 5x net, type of thing.
And yeah, we've been lucky to have that with a couple companies. What is with Plaid, was that in the same first fund? 2 in the first fund? That's great. 10 billion and 5 billion.
We were in Cruise also.
Cruise was quick billion. So you have 3 unicorns, 1 decacorn.
Gusto.
In that same first fund.
And a company called Weave out of Salt Lake in the SaaS space. Their last round was at 970 post, and I'm pretty sure based upon secondary interest that if they raised again, it would be, north of.
Dude, congratulations. That's 5. That's legendary. You and Roger Ehrenberg. Yeah.
There's scattered ownership, right? So Chime is the wonderful intersection of real concentrated ownership and hopefully great outcome. The other ones all are across the spectrum. Nothing minimal, nothing where it's like, oh, they sold for $5 billion and we got $1. Right. But like, I don't want to toot my own horn. I don't want to say like, oh, each of those is, each of those is $1 billion back. It's like,
yeah. No, I understand. So now let's talk about the other side where you leaned in, because not everybody has these type of stories. We are in the middle of one where you lean in and everything's going well, or you're not quite there yet, but you're keeping your pro rata and it doesn't work. You've had one of those, I imagine.
Oh, sure.
Yeah. So can you talk about it?
Oh yeah, absolutely.
Is it the delivery? Is it one of the delivery companies?
Oh, Ship. Yeah, in the first fund.
Okay, so yeah. Ship. So tell people how to deal with that, because that's a real story. Like you gotta. Sometimes it doesn't work.
Sometimes it doesn't work.
Right. Yeah.
So beloved service, right? So the idea that whether you're a small business, an office, a consumer. SHYP. Somebody should come to you. Should be able to basically press a button and say, I want to ship this somewhere, and everything else should just be taken care of. Like, and so they built. The founder, loves logistics, and I always think like loving a weird niche is always a competitive advantage. And launched an amazing service that felt like magic. Whether you were selling on eBay or you were, selling on Etsy or you were an office manager, like having to package people were even using it to like ship their bags, I'm going to New York, let me just ship my bag, or I'm in New York, I bought a bunch of stuff, I don't want to carry it back in the airplane. I'm going to press this button, somebody comes to my hotel room, takes everything I bought, packages up, and it's waiting for me by the time I get back.
Right.
With a slight premium, but not, wasn't just a service for the 1%. Ended up launching in a handful of cities, and never quite got to the scale they needed, largely because the consumer business was high margin but low volume.
Didn't happen often.
Didn't happen often enough.
Got it.
As Kevin, the CEO, wrote, I think in his postmortem quite correctly, the fact that they had raised a bunch of money, I think $50 million, let's say, made them believe that they could
keep going.
Yeah, move gently off of the consumer business and ramp up the SMB, Shopify, so on and so forth, but not have to like rip the Band-Aid off and just, go and focus on what was actually going to be the business. Because when you have $50 million in the bank, the idea of, hey, we're going to spend $4.5 million this quarter to support, the consumer business seems like, well, that's less than 10% of cash on hand. It would be terrible for the brand if we stop, like blah, 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 blah. But then when you have $5 million left in the bank, you wish you would have had 10, And so that ultimately, went to zero for all intents and purposes. It went to zero, before the Plaid acquisition, before Chime was working, before,
right. Early in your fund, yeah.
Early in the fund. So we had Cruise, so we had one nice return, but you could essentially say, well, okay, now we have in a $35 million fund, we now have, let's say, a $3.5 million hole to dig out of. Let's say, I don't remember if we had $3.5 million.
It was a big bet. It was a big bet.
But it was a big bet. We had put into the seed, the A, and the B.
That's what I remember. Okay.
And when Satya and I looked back at it, we said, to be honest, like, let's look at this with actual intellectual honesty. The mistake was the B. The B was at a high price, big round, but we got greedy.
Okay.
We're like, this
wasn't ready for a B. You think like the data wasn't there?
I think at the time, anything that smelled like could be Uber for X, whether it was parking your car, whether it was shipping something, whether it was meal delivery, a lot of,
for us, dog walking, wag.
Yeah, dog walking, a lot of companies. And it doesn't mean that there won't be, doesn't mean that there's not a DoorDash. It doesn't mean there's not a this, but there was a lot of venture capital that got, spent, subsidizing, interesting businesses in that year. And I think if you look back, I say, we feel 100% good about the seed and the A. It's the B that we got greedy on. Mm-hmm. I tell you, the thing that and I don't know how you deal with this, Roger. Maybe the way you invest, you don't think quite as much about like conflicts, but because we sign up, we take a board seat, like I have to think about, even if they're not directly competitive, I need to give this company a little bit of room to run, so on and so forth. The investment in Ship caused us to say no to 2 other logistics related companies, not because it was a bake-off, but because we made the investment in Ship first. And then when those other 2 companies pitched me, I had to say, look, I know it's not competitive and I know you're not worried about it, but like I need to stay focused. And both of those companies are doing great. And so what I think about more, and what's almost more painful for me, and when I think about,
opportunity cost,
is the right sector, wrong company.
Mm-hmm.
I can't trade out of a position and into another one. So we occasionally will sometimes challenge ourselves and say, is this really the investment we want to make in this sector, or do we want to hold off a little bit more? Now you can always imagine that there's going to be a better company that walks in the door next week that you haven't heard of. So you can never make an investment if you want, but that's not what we're paid to do, right? But I think in the first fund, there probably was a little bit of learning about when you have conviction in the sector, maybe the first company that like makes your heart flutter, maybe that is or isn't the company you ultimately want to be in.
That's really educational, so I'm glad I went there. I'll leave you with this. It's late 2020, election's a month away or so. What do you have
So I hear.
So you hear. What do you have other than your beard? What in venture and tech do you have 100% conviction in 3 years out?
100% conviction.
So you can take a big picture, like what do you just know?
I mean, so we've made a few investments around, so it's interesting coming out of.
It could just be the NASDAQ, it could be technology, it could be, life.
I have great conviction that the quote unquote creator economy is real and growing, which I mean sort of, let's call them, SMBs, where the product is, content, community relationships, and all the other ways that I can create and monetize those micro communities. It doesn't just mean influencers. It doesn't just mean newsletter writers, but the idea that there are going to be more and more people who are getting at least some portion of their income, from something that is content-based, and those people need better tools. Whether that creates 30 amazing venture outcomes, 1 amazing venture outcome, 0 venture outcomes, because it turns out they can use existing tools.
Like a Discord or an OnlyFans? Is that what you're talking about?
Yeah, all that type of stuff. So we have a few investments in what I sort of call picks and shovels for that economy, and then a few that are a little bit more, consumer facing. But I saw this at YouTube. I saw this at Second Life. I saw this at AdSense. So I have a lot of history in kind of seeing when attention moves somewhere very quickly, that dollars follow, and they follow sustainably. Maybe not in any one person, like today's streamer might not be tomorrow's, TikToker, whatever.
Right. But the platform exists.
These economies are real. And so the biggest question for me is what sort of venture scale companies can be built, given that, you're going from an anecdotal economy, to a meaningful one.
Well, I'm excited. You killed it. Thank you. I hope we can work on something around the creator or fintech, because those are if I'm going to get out of fintech, obviously it's creator economy. And that's where I've had my most success, writing and thinking and using these products. And I'm super with 2 young kids who are my go-to now on testing. They're old enough to test things that I want them to test and write reports and give me.
I hope those are paid internships.
They're not. They're both working, so it doesn't matter. But they just are starting to use the products and starting to give me feedback on the products, and their networks are starting to overlap with my networks, which is just I'm having the best time, because they're just starting and their networks are overlapping with mine. So I can't imagine the next 20 years. But I think that's very helpful for people that are both investors, just to know some of the details that you gave there. And then on the creator economy, I mean, you couldn't think, there is just a tidal wave of the iceberg. The 99% of people that have never been discovered are still there. And so
by opportunity and necessity, we're going to be unlocking a lot of creativity and economics around that creativity.
Good way to end it, Hunter. Thank you, and be well.
Thank you so much, Howard.